This is Berkeley video series for CMA. Today we are going to discuss Unit 10, which is investment appraisal, and in the second part we will discuss the ethical consideration. This is CMA part 2. Broadly we are going to discuss these things. We will start our discussion with the real example to analyze net present value, IRR, and payback method with the profitability index. Along with that, we are going to discuss the risk analysis. We will see how to mitigate or averse or divert the risk, and real option in capital investments that an investor has for his investment. Then we are going to discuss corporate valuation methods. In the last, we are going to discuss the ethics and legislation and the corporate responsibility for the corporations. We will start our discussion straight away with the net present value. This concept is with the time related with the time value of money, which says that money loses its value with the passage of time. Now, as an investor, we want to see that whatever returns we are going to get after 5 years, 7 years, or 10 years, we have to see what is the worth as of today. That is the concept of net present value. Same way, opposite is the future value. We want to see that what could be the future value of some investment which we are going to do as of today. While calculating net present value, we have to discount the cash inflows and outflows. It may be a different stream. Every year we are receiving a different amount, or it may be a regular amount that we are receiving every year. This will be called as annuity. In this question, we have net present value, that is after tax cash flows, into present value of an annuity minus net investment. By using this formula, we are going to calculate the net present value. Along with this, there is a method called IRR. This is internal rate of return. We assume that net present value on this point, when it is 0, this is the best point and this investment is very good. In terms of net present value, we assume if the net present value is positive, then this project is good, we should go for this project. Otherwise, if the net present value accumulated total is coming negative, means this is not a good investment at all. In IRR, we are going to focus if net present value is equal to 0. For that, we try different discount rates, so we can achieve to a point where NPV becomes 0. Then payback period. Every investor is interested to know that whatever investment he is going to put, how much time it will be in his hands. This is the payback period, which is we take net investments divided by after tax cash flows. So we can see here in this situation, in 3.19 years we get whatever we invest initially, that was $18,000, and we have a profitability index which is equal to net present value of the future cash flows. Whatever cash flow we receive in the future, we have to make it we have to calculate the net present value as of today, and then we have to divide it with the net investment. So it will show us in index form that what is the real profitability out of it. Then surely we are going to discuss the risk analysis and what is risk, what is the procedure for the risk analysis, and how we can reduce this risk from the business operations. Start with this risk analysis, attempts to measure the likelihoodness of the variability of the future returns from any investment. We have certain methods to approach to assess risk. First method is informal method, which is based on NPV as the calculated to see the desired rate of return, and if it becomes positive, surely we go for it, and if it is negative, we go and we think to reject that one. Then we have risk adjusted discount rates. Discount rates, when you apply the discount rates on any investment, is going to adjust the inflationary impacts inside, and it will give you a reduced figure which will be more closer to the reality in terms of the returns. Then we have certainty equivalent adjustment. This technique is drawn from the concept of utility theory, where certain curves are giving you the points where the curve is indifferent to the option. And simulation analysis, we use this is a statistical method, and this is highly sophisticated and more expensive to apply. This method represents a refinement of the standard profitability theory. This theory is says that this theory is used to calculate the real profitabilities, and surely it is going to help reducing the risk. Then we have sensitivity analysis, where we are going to put ourselves in a position where we assess that what factors are considered more sensitive, and keeping focus on the sensitivity or sensitive factors, we can secure ourselves against from the risk. The Monte Carlo technique is also used for the simulation to generate the individual values for a random variable. Then we have CAPM, that is capital asset pricing model. This model helps us to see the variability of the investment. We use the concept of beta, which is a unit to measure the variability. So this is for one risk. For one option we can use this model, and for the different options we can use arbitrary method for the risk mitigation. What are the other options that we have in terms of investment? The option that we have is the availability of the real option is very critical to read in terms of analyzing when the investment is going appropriate or not. Real options we cannot see in terms of financial terms, and we have to make a decision tree, see the probabilities and the outcomes. We can replicate the portfolio. This method involves identifying securities trading efficiently in the public sector and focusing on them, and sometimes abandonment of the project is desired, and we have to sell all the assets, or we can engage it into a different project. Then with the option of making a follow-up investment in expansion may be the factor in this case. And follow-up investment is we have to sometime wait and see or postpone based on our market conditions. We have to take the decision accordingly. Then the flexibility option to vary inputs, for example by switching fuels. Capacity option to be vary output, and we can find a new market, new area. If we are in US, we can go to Europe, we can go to Middle East and the African markets. We can expand the product line, and we can expand the research and development, the opportunities, and surely as an option we can go for a call option or a put option. Then there are certain methods for the corporate valuation for the related to stock and equity. We have dividend discount model, in which you take dividend per share, you divide it with cost of capital, and you can subtract as dividend growth rate. This is based on the growth level observed in the stock exchange, and the movement of the stock will tell you what is the growth level. Along with, you can calculate the EPS, that is earning per share. Earning per share is net income available to the common shareholders divided by average share outstanding. This EPS is going to reflect the earning per share, means how much investment the investor has been divided into a share, and how much each share is going to contribute towards the income. And we can see the book value per share, which is equal to shareholder equity divided by shareholders shares outstanding. Again, if you want to see how much yield the dividend is making for, we take dividend per share and then we divide it market value per share. Same way we can calculate the price earning ratio, which is market price divided by EPS. Earning power, most analysts prefer to use diluted EPS. What is diluted EPS? It's a discussion between the analysts that the preference share is not a true form of equity, because when we issue preference share, we commit the shareholder a fixed rate of dividend, which makes them a little ambiguous in terms of liability or equity. That's why from EPS we exclude the preference stock. Earning power is defined as the company ability to generate income for the normal operations. From EPS diluted, we are going to subtract the preference stock, and for price book ratios, market price per share divided by book value. Book value is the face value or the value on which the share is issued, in fact, and the price sale ratio is market price per share divided by sales per share. And surely in the last portion we are going to discuss the ethical part and the IMA guidelines for the business operations. Generally, it was observed that the US company, when they expand their operation in all over the world, they were found and they were strong evidence by bribing the government officials of the other countries. For that, they make one act, that is Foreign Corrupt Practices Act,